So the wicks trade into the BPR, fill in the fair value gap in the BPR, right, and then rejecting. Where I actually entered the trade at this point was here. So I market executed on this trade. What's going on, family? It's your boy Romz again with another trade breakdown. This is actually a trade that I took from the 16th of August. It was a 12-hour trade. Very, very solid trade, if I'm honest with you. But I'm going to break it down. I'm going to go into a bit more detail today in regards to a couple of entries and exactly what I was thinking. So you see here now I'm starting on the 15-minute, but what I'm going to do is, I like to do this. I like to go on to the higher time frames to give you guys context of what I'm looking at. Always start at the higher time frame. So we'll start on a weekly. All right. So if we look on the weekly here, we can see that what's important to know is that price is constantly making higher highs, right? It's making higher highs, but it's also sweeping lows on the way on the daily. Okay. So we can see here that, price came down, took out this low here, made a new high, came up, took out this internal liquidity. All these just build up, took it out, then went higher and created a new high. So now price is retracing into the discount area of the daily time frame. Okay. So what I'm at here is you can see we've got this fair value gap here with this gray box. We've got this fair value gap on the weekly time frame here, and this is my current draw. That was my draw at the time, my draw of liquidity at the time, right? So that's the weekly time frame. And we look at it on a daily, it gets a little bit more clearer. We can see here, as I've marked out to the left, the liquidity being taken and new highs being made. Again, down the here in the slow, liquidity taken, high being made, and again, all of these lows taken out. And just make it a bit more clearer for you, tapped into this fair value gap on the daily. Fair value gap. You can see how the bodies of the candles respected that fair value gap. Didn't trade through it. The wicks did, but the bodies respected it, made a new high. So now we're looking at, where we going next, where's the next draw? So what we did have is we had, a new high created on the daily, and then we saw the price was retracing, and then first things first, you see this daily fair value gap, right? Daily fair value gap. So once you get the price comes into here, you think, we could reverse from here and keep going higher. It's possible, definitely possible. However, look what happens. Look at this wick here. This wick takes out these highs, and then we create a new low, right? So you can see, first of all, these bodies of the daily respect this fair value gap on the daily. All right, let me quickly mark this out for you guys so you can see. Daily fair value gap. The bodies are respecting the fair value gap, right? So initially, you could have caught some buys in here on the lower time frames, but then price wicks up and then comes back down, rejects off these levels into this order block here, and then we create a new low. All right. So once that happens, okay, we're not reversing from here. So that means that this draw has been fulfilled. All right. But it's not rejected from here. We're going lower. So where's the next draw? And the next draw was clearly these lows here. And we knew on the weekly time frame, we had a fair value gap, a BISI, right? So that was the next draw of liquidity. So on a longer term basis, that's where I was headed, right? Cool. So that's the daily. So if we go down even lower now, cool. So we can we're on the 4 hour now. We can see the fair value gap on the weekly. That's the draw. But before we even get to that, that's the longer term draw. We do have other draws of liquidity. So we've got these little low here that I've marked out, which for this trade, this was my actual target for this trade. All right. And framing that, what you've got here on the 4 hours, you've got these wicks. For example, this wick here, taking out this high and tapped into this fair value gap on the 4 hour. You see it? ICT will class that as a institutional order flow entry drill. So basically when, price basically just taps in to the fair value gap and rejects, right? And then we've got another wick here. This takes out this high here, and then it looks like it's rejecting hard from this zone. Okay, but on the 4 hour, it's still not very clear in regards to where we could enter here. But we know where the draw of liquidity is. We know where we're heading. We're heading bearish, and we're going to trust the draw. So we go down to the 1 hour. Okay, things are getting a little clearer now. So marked out the daily fair value gap. That's been traded through now, right? And some people might see this here, and you might think, this aggressive push down might be, a chance for price to maybe be, taking a sweep of liquidity for it to then reject and go higher. But what we haven't had is a market structure shift, have we? On the 1 hour. The market structure shift did not take place. This is a strong high. Why is it a strong high? It's a strong high because it's taken liquidity to the left, it's taken a swing high to the left and created a new low. This is what I class as a strong high, right? So instead of price coming up to this zone and breaking this high, right, it rejects from it. This wick here rejects from this high, right? And then it rejects heavily, and you see these bearish candles that we're getting aggressive push down. So that gives you even more confirmation to where price is headed. So we've got our draw of liquidity. We're seeing what's happening, and we're going down to the 15-minute, and this is where things get really interesting. This is where I'm going to go into some detail for you guys today. All right. So what we've got here is we've got the draw of liquidity on the 15-minute. That was my target for the trade. That's where I want to take all my profits off. Okay. And let's just frame it for a second. So we've got this here. We've got this 4-hour SIBI. Let's have a look. 4-hour SIBI just here, which price had traded into. All right, taking out this high, took out this high as well, and it filled this fair value gap on the 15-minute. Right, took out the highs and then created a new low. Okay, so because I class this as a strong high, because the draw of liquidity is bearish, I believe that this strong high should be protected. All right, I mean, we can see here, look, price comes up on the previous day. You can see here. So on the Tuesday the 15th, price had come up into this 15-minute fair value gap and the 1-hour fair value gap, right? And the SIBIs, and rejected again, looking bearish. All right. So this was me now. Start of London session, London kill zone. So start of Frankfurt, 2 a.m. New York time, 7 a.m. London time, right? Where I'm based in London. So I was looking at this now, I was like, okay, I know what my target is. My target is bearish. I've got my draw of liquidity down here, this black line which I've marked out as sell side liquidity. This blue box is my Asian range, right? So what do I want to see before price goes to my draw, before price goes to my target? I know that for us to go lower, price must first have to induce higher, and vice versa. So if we were bullish, price would have to induce lower before it goes higher. So in other words, if we were bullish, price would have to sweep a low to then create a new high. On this occasion, we're bearish, right? So I knew that price would need to take out some kind of swing high before we go and create a new low, right? So what am I seeing here? So I'm seeing a couple of things. First things first, I'm seeing this fair value gap here on the 15-minute, which is perfect, right? It's a 15-minute SIBI, 15-minute SIBI, yeah? Sell side inefficiency, sell side imbalance, buy side inefficiency, right? And then what do we have just before the fair value gap? We have a swing high, and this is perfect for liquidity, right? So I see this as a liquidity point for price to tap in, and so price to take that liquidity on the way into the fair value gap. Remember, I say this on a lot of my videos, price is only ever doing two things. Price is either seeking liquidity, yeah, while creating liquidity, but seeking liquidity, right? Or price is moving towards inefficiency to make the market efficient. So the price is either seeking efficiency or seeking liquidity. Two things, only thing it's doing. In this case, it's seeking efficiency to fill the fair value gap. That's what I believed at the time anyway. And it was seeking liquidity, which was this swing high. So it will take out this swing high, tap into this fair value gap, to then move lower. That was where I was looking at it, right? This was the 15-minute. Another thing that what I liked about it was the fact that this swing high took out this swing high. So where I've marked out these lines, so these lines is basically showing me where liquidity has been taken, right? So liquidity has been taken by this swing high, and I believe that swing high would be my protection. So if I was looking at this like the way I'm looking at it, I could be like, I want to enter this trade here, stop loss above this high, and this is my target. Boom, 3.5R, right? I don't trade that way. I like smaller stop losses, and I like sometimes I like more confirmations as well. But I wouldn't necessarily need it in this case because I've got a good idea where price potentially could be headed. If I took a loss on this, I wouldn't be gutted because it had so many confirmations. But I want to show you something else, guys. Let's go down to the 5-minute. So this is where things get really interesting, because on the night before, when I was doing my journaling, I actually marked out this on my journal. And what I want to bring to your attention is this bearish order block right here, right? So you can see this M5 bearish order block here, right? So why is it a bearish order block? So a bearish order block here, this thick up candle, right? before the down candles. This for me was a high probability order block, because first things first, we've got buy side liquidity just below it. We have the order block itself having an imbalance just before it as well, or within it, should we say. And the order block itself had taken liquidity. This, and the fact that also it's also in premium, right? In regards to the premium and discount of the range of the market, it's in premium. So I'm looking at this, I'm like, okay, I'll mark this out. So what I could have done even then was, mark this trade out. To mark this trade out was enter here on the order block, and we got here what, 4.5 R pretty much, right? Again, though, I didn't want to do that. So this is what I was looking at, and I'm going to show you how it plays out and what I was looking at the time. So this is now the 5 minute. I'm going to keep playing just to see how it played out, right? So this is now London session, London kill zone. So let's press play, see what happens. Cool. So what you can see here is, price moves up aggressively and it starts to play around a bit, maybe inducing some early sellers, people to try and get in early, people thinking that it's rejecting, and then boom, right, price taps into the order block. And just what's important about this as well, guys, is look at the way it's tapped into the order block. It's rejected with the wicks. The bodies of the candles haven't, violated the order block at this point, and we start to get real rejections, right? Again, price comes back up again. Boom, rejection again, right? And then, boom, look at that. So let's go on the 15 minute as well now, so you can see it out on the 15 minute too, yeah? So as you can see, we've got the 15 minute fair value gap, right? We've got the 5 minute high probability, highly probable order block, right? You can see on the 15 minutes even better, right? In regards to the wick. The wick completely rejects the order block, swings into the fair value gap, doesn't stick around in the fair value gap, all right? And again, when price comes back up on the 15 minute, again, it barely trades into the fair value gap again, respects this high, this wick that's tapped into the order blocks, respecting it, and we get a strong rejection. And this is actually during London lunch. Well, I don't usually like to take trades during London lunch. And London lunch is between 5 a.m. New York and 7 a.m. New York. So for my time, it's usually 10 a.m. UK time to 12 p.m. UK time, depending on, daylight saving and all that jazz. So I always keep my charts based on New York time, because that's what the algorithm is based on, and that makes sure that I'm always in line. Right, so we had these rejections. You can see at this point now, price was looking real good in regards to the way it's reacting from the zone, right? Back down to the 5 minute. So what you can see here is, again, on the 5 minute, price has gone up, and I'm gonna go down to the 3 minute as well now and show you what happens here. So we've got on the 3 minute, price has created a BPR on the 3 minute, balanced price range, right? And then price has traded into the balanced price range, rejected again. Look at the wicks. The wicks. ICT always says it. The wicks do the damage, and the bodies tell the story, right? So the wicks trade into the BPR, fill in the fair value gap in the BPR, right, and then rejecting. And where I actually entered the trade at this point was actually, make sure I got the exact same entry that I took. Cool, was here. So I market executed on this trade. And I put the stop loss just above here. I can't remember exactly why. I could have easily put it here. There must have been a reason why at the time. Maybe it was just to do with the amount of stop loss size that I used. But what's important to see here is, let me just do it with the 3 minute. I think that's best. Cool. So we had price reject from the order block, okay? And then created a BPR. It's a strong rejection, and then prices have gone back into it again, and it's rejected heavily again, with the wicks rejecting, and then the price coming up, and then rejecting again, sweeping these highs as well. Price sweeping the highs and then rejecting again. And once I saw that price was rejecting again so aggressively, our market executed exactly at this point. And there's a 4.2 pip stop loss at the time, and I knew what my target was. So the thing is, I had two targets now. First things first, Asia low, right? So Asia low is actually this low. I think I used it at the time. Can't remember. But let's go for Asia low. So Asia low was my first target. I was always going to take some partials at this point. Why? Because price can always give a deep retracement, yeah, or heavy rejection once it has taken liquidity. And at this time, I had a couple trades that I'd taken that week, I believe, that went to break even, and I wasn't in much profit. And I was like, this alone is a 6.7R trade, man. Like, that's solid. Take some partials. So that was my first target, and then this bottom one here for 12R was my second target. But let's see how price began to play out. I press play. You can see here price moving up and rejects, and then even give us another entry here. If we want to enter again here, we could have entered again there. We could have. But I didn't, obviously, because it was too close to my original entry and I wasn't at breaking at this point. I didn't want to put more risk on, so I left it at that point. But let's see how we continue to play out. Trading away, boom, right, cool. So this at this point here, so you can see price kind of was playing around a little bit in the sense that it was up, down. It was respecting the highs. It didn't violate any highs. It was respecting the highs, but it played games a little bit and I wasn't liking it. So what I actually done, guys, for full transparency, is I took my whole position off at 6.8R, whatever it was, right? I didn't wait for the 12R, but I'm going to show you what happens next. So I took my position off there, and that was me done. And I was actually happy because I had a couple trades, like I said, that were playing around that week. And I was like, I need for my psychology, I'm developing this still, guys, just being real with you. But for my psychology, I needed that solid win. So I took it, and it put me in great profits for the week. So remember what I said though about the rejections and about the retracements and the reversals. Price will give you heavy rejections or potential completely reversals when it takes a significant amount of liquidity. Look what happens as soon as my take profit gets hit. Look at that. Look at that. And then price goes on to then eventually, could happen if I held my trade, boom, hits my target for 12R, right? But let's be real, guys. Psychology wise, let's say I took half at 6R, solid amount of partials. Imagine me riding it up, seeing the trade pretty much reversing back down to 1R. From 6.8R to 1R, that would be heart-wrenching, right? That's just me being real. So I was glad I took my full position off there at that time because of how my week was going. So that's what I did. But the question you also need to ask is, if the target was here, down for 12R, this sell side liquidity, why did price reverse? And why did it reject on this area, right? Why did it reject here to then go further? The market is never random. There's always a reason. And I'm going to show you. Look on the 1 hour. On the 1 hour, you can see here that price, right? As we were moving down to my target of the Asia low, price had created 15 minutes, no, definitely 1 hour. Yeah, price had created a fair value gap or a SIBI on the 1 hour time frame. This block right here. Right, so that little gray box that I've just created, you see that fair value gap there? Look how price traded into that and rejected from that zone. Literally filled it in and then rejected, right? Remember what I said? Price is always doing two things: seeking liquidity or trying to make the market efficient. Seeking efficiency or seeking liquidity. But let's look deeper. How could we have actually entered this trade? What is the logistics behind what price actually did? Let me tell you what it is before I wrap this up. Price rejected or retraced after taking liquidity of Asia low, right? Took out all of this trendline liquidity and these ones down here, right? Took out all of that trendline liquidity. Quickly move this out of the way. Took out the trendline liquidity, so seeking liquidity, fill in the H1 fair value gap, right? Which is what it done, right? So it took out main liquidity and then it took out internal liquidity. What do I mean by that? Look at these highs here. This is the 1 minute now. This is where it gets like real technical, right? These two highs, equal highs on the 1 minute. This high right here took out the previous two highs. Look, see it? This high is slightly higher than the other two highs. See it? Look at that, amazing. So if I wanted to, I could have entered again during London close, right? Once I saw on the rejection, I could have entered maybe, you know, further down here, just to be safe, rather than trying to enter too early. With another, you know, let's say 6 pip stop loss, and then go for my target again. But let's be real, guys. Again, full transparency. I'm never gonna lie to you online. I'm not one of those people to lie to you. I'm giving you full transparency. At that moment in time, I didn't see it. I didn't know why price was retracing that deep at the time. It was only once I journaled, once I realized. All right. So price went down, hit 12R, boom, solid trade. So it shows you if I just took 50%, I would have made about 9R in total, but I didn't. I made 6R roughly. I made over 6R because I just took my partials at this, my full position at this point here. Remember, hit like, hit subscribe, and I'll catch you soon. God bless.